to do that. Now I'll repurpose this, so I'll download it and repurpose it for the other platforms, so you guys can catch it later. Most of my students already know that they have access to all of these things directly, but let me make sure sound and everything is on. All right, cool, cool, cool. All right, we are three, two, one. Now we are really live. All right. So most people invest in real estate. They think of fix and flips and long-term holds and maybe tax deeds and tax certificates. All that stuff is fine and dandy when things are good. But being a real estate investor means you have to be able to generate income in the real estate investing world outside of those things. So that could mean buying and selling debt. That could mean putting deals together for other people that you're not an active participant in. That can mean a number of things. So I'm going to teach you this morning how to put a deal together for somebody else that you're not involved in, but get paid, right? So a group. Now, keep in mind, this is a group of friends, and I'm not talking about syndication, going out to the general public and raising capital and for real estate investing. I'm talking about you already have a pre-existing relationship with these people, right? Because if you don't, if you're doing that for the general public, it's heavily regulated and you can get in a lot of trouble for soliciting these types of things. So my name is Otis. I'm the founder of the Four Data Points Academy. We are a real estate investing training platform. We take people from zero knowledge and they stay on with us until they determine they no longer need to be. So we educate people until they're advanced and savvy enough where they can go off on their own. And then folks that are advanced and still in our circle, they're just in a different capacity. We start doing things together. Maybe we'll flip some homes together, or maybe we'll go build stuff or whatever it is. But I'm training these people from zero all the way up to advanced. This is one of the things that I train in our real estate family, in our real estate training platform. So bear with me. Give me a minute. If you guys have any questions, any real estate questions, I'll go ahead and answer them. You feel free to interrupt me. Crystal, how you doing? Crystal, I should have you come up here so you can look at any of these questions. Let me see. I use to simulate on real estate. Okay, yeah. ChatGPT is a useful tool. Just make sure if you guys are using ChatGPT, understand that it's garbage in, garbage out. I use ChatGPT to organize lessons and spell check stuff and all of that. I can auto dictate so it can draft my emails and stuff like that. But understand, ChatGPT is really just taking information that's readily available on the internet and organizing that information for you. So just be careful if you guys are using ChatGPT. Why would I say yes to this number? Well, you shouldn't yet, Justin. So sit tight. Justin got a real picture too. All right. All right. So you folks that want to be real estate investors, I'm going to give you some gems to take with you. You guys in our real estate family already. You have this guide. This is about a 19-page guide that I give to folks in our real estate family, just in case they want to do something with each other, right? So I mentor personally about 350 people, and there are times where maybe they might not have the liquidity to do one thing on their own, and I was asked, hey, can you put groups together so we can invest together? It'd be a good learning opportunity. So because that had to be organized, I created this guide. So we're going to get into it in just a second. As I was saying, I'm the founder of the Four Data Points Academy. I'm also a licensed real estate broker in multiple states. I am not in that capacity. I hold a broker's license in California, broker's license in Georgia, but I can't justify the time to actually do listings and things myself. I'll typically pass it off to someone else. I spent about 13 years in the mortgage industry while I was a real estate professional. We funded just under $1 billion in a short time. Well, it's 13 years. It's a short time in the big scheme of things, but not really. So we funded just under $1 billion in mortgages. I also spent over 2 decades in the multifamily commercial industry. So it was my job to make sure that these large apartment developments were profitable. Profitable. I was on the operations side. I'm considered a long-term hold investor. My criteria is buying a piece of property, make it worth more than I bought it for, leveraging that value, keeping the property cash flowing, and going to buy another one, leaving a trail of cash flowing assets in my wake. So you folks on TikTok, I can get to those I can get to those questions in just a second. Can I do a 1031 exchange with a townhouse to purchase a business being sold with real estate? It's got to be like for like. So if that townhouse is an investment property, then it has to be another investment property. Now you can do a 1031 exchange and change asset classes. All right. So if you have like a duplex, you can change that to like a 5 unit building and do a 1031 exchange. But just remember, who is that? Build wealth digitally. It's got to be like for like. All right. I've also consulted on projects, not just domestic development projects, but overseas and, in multiple countries. So I'm well versed in the different aspects of how they do things overseas and a bunch of other things that are way more impressive on purpose and in real life. So let's jump into this. Let me see, is Clubhouse? Oh, I think I got Clubhouse. Yeah, Clubhouse is listening in. I opened that up so they can see or hear what we're doing. All right. Now let's get to the common sense stuff. You guys that shared the room on TikTok, really appreciate it. You guys keep sharing the room. If we can get up to 30 shares, I got something special for y'all. All right. So why do we invest with friends? Now keep in mind, it's friends. You have to have a pre-existing relationship. Again, if you do this for the general public, that could fall under syndication, and that is heavily regulated. So you can't just go out and solicit these types of things for people you don't know. This is for people that have a pre-existing relationship and they want to pull some funds together and invest. So why would they do that, right? Number one is shared financial resources. If I've got $10,000 and I'm a new investor, there's not going to be much that I can do with $10,000 in the grand scheme of things. But if I know five other people that also have $10,000, all right, now we're at 60. Now we can do something, but we got to make sure that everything is on the up and up. So pulling financial resources with friends and family obviously has its advantages because you can go a lot further by combining funds, putting funds together. You can pursue larger, more lucrative deals. What's the other reason you would do this? Diverse skills and expertise. Each member of a friends and family. I don't know. I can't talk this morning. You know what? I think I started too early and I haven't finished my coffee yet, so y'all gonna have to bear with me on that one. Diverse skills and expertise. So you put a group together because people have different talents, and if you can get a really good group together, you can form an entity together and really make a business out of this. So diverse skills and expertise, increase support and trust. Investing with people you know and trust can create a supportive and collaborative environment. If it was outside of our real estate family and the people that I mentor, I probably wouldn't do it at all. But we know, like, and trust each other. It just makes things go a lot smoother. Why else would you invest in a group? You share the risk. You spread the risk out. So if I've got, in the example I gave, six people with $10,000, if we invest and the investment goes bad, then we just lose our $10,000. But if it's one person with $60,000, then guess what? You can lose your whole $60,000. So you share the risk. All right. Real estate investing is an emotional thing, right? And when you're investing with a group, when you do it the right way, you've got multiple people, multiple personalities, and there's some accountability there. So if somebody isn't pulling their weight, there's an accountability component to it, and you can hold that person to it. You can leverage existing relationships. You can, there's a lot of learning. It's a really good learning opportunity. Part of the reason that we started investing with groups is to teach people how to do it in all the different aspects of starting from zero, finding the property, assessing the deal, meeting with contractors, understanding how to manage the contractor relationship, understanding how financing goes, understanding how we exit. And it's done really, really efficiently the more people you have, if you're good at it, right? And of course, there's emotional, psychological support. You strengthen your relationships. It's flexible investment structures, blah, blah, blah. All right. What people don't realize are the reasons that we don't want to invest with groups. There's a few reasons we don't want to invest with groups. It strains the relationship. Investing in real estate with a group, especially friends or family, it can be rewarding, but it also strains relationships due to different goals, different financial disparities, decision making challenges, communication breakdown, can be legal issues, personal dynamics. a differing exit strategy. So to mitigate these risks, it's important to draft clear agreements. You got to have this stuff on paper, and basically, it's the rules of what you're going to do. Good morning, Vince. It's going to be the rules of what you are trying to do. Okay. And I'm going to show you how we organize that here in just a second. Another reason not to invest with a group, different goals and expectations. There was a situation where there was a group that was already put together, and they called me for a consult, and we started talking, and there was just some people had a sense of urgency that was a little unreasonable for what it was that they were trying to do. And so I talked to the group, and then I talked to individuals within the group, and come to find out, one person had some gambling debts that they had to prioritize. So this one person had a sense of urgency. Well, for the type of investing that they were doing, this wasn't they weren't going to exit to where they were going to get a lump sum of cash. This was going to be a long-term hold. So there was a lot of friction in the group because one person's personal obligations was getting in the way of what the group needed to be doing. Okay. So another reason that you probably don't want to invest with a group is understanding different goals and expectations. Okay? All of that stuff has to be ironed out. And I'm going to tell you guys how to have that conversation here in just a bit. Another one, and this is a big one, lack of professionalism. So working with friends and family can sometimes blur the lines between personal and professional interactions. When you are investing, and when I invest in groups, when I put groups together, it's for a quick infusion of cash. So we'll go ahead and go ahead and get organized, and then we'll plan our exit. We'll probably exit for 4 or 5 months, depending on what the market looks like, and then we got a lump sum of cash, and then whatever entity we used, we dissolve it, and everybody goes their separate ways. All right. And in that process, there's a lot of people that we have to deal with. You got to deal with appraisers. You got to deal with contractors. You got to deal with the closing company. If you have people in your group that have a lack of professionalism, they can make it a lot harder for everyone else. All right. So that's another reason not to invest in a group. Potential for unequal contributions. And folks, keep in mind that these are all conversations that I've had with people that were investing in groups. They weren't all my, students, excuse me, but probably most of my consults, people will call, it'll be a group call that we'll set up, and we're talking about the things I'm talking about now. And probably the most prevalent issue that these groups have is unequal contributions. Well, this person's not doing anything. Well, I put in this much money, this person put in a lot less, and they're not pulling their weight. So all of these conversations and expectations need to be ironed out beforehand. So when you're investing in the groups, I'm going to take it, we're going to go in steps. All right. So step one, investing with a group. Now, if you text yes to that number above my head, I'll go ahead and give you this guide. Um, and you guys can review it for yourself. Before I send it out to everybody, I'm just gonna update it. I did this one about 2 years ago, so every time I do a lesson, I revisit it probably every 1.5, 2 years, just to make sure nothing's changed. Right? No legal issues or things have changed. So I'm just making sure that everything still applies. But if you text the word yes to 702-710-8030, a number above my head, you folks on TikTok, I can get you a copy of this. If you guys are already in our program, just go in the portal. I'll have this in there for you guys if you haven't downloaded it already. Step one, define the group's goals and structure. Okay, I'm not going to spend a whole bunch of time on legal structure. Talk to a qualified professional to see what legal structure is going to serve its purpose the best for you. But when forming a group to invest in real estate, it's important to clearly define the group's objectives. This involves detailed discussions and consensus on various aspects of the investment strategy. So we're going to go into a step-by-step to help you establish these objectives. Again, you folks on TikTok, if you could share the room, that'd be dope. This is a new TikTok page for us, so we're building it up and going through all those growing pains. So it's much appreciated. All right, first discussion, group meeting, initial discussions. So you're going to gather all the members. You're going to arrange a meeting with all group members to discuss the investment venture. Then you're going to have some open dialogue. You're going to encourage open and honest discussions. Now, this is me as a mediator now talking. You're going to encourage open and honest discussions about individual expectations, goals, and concerns regarding the investments. If I'm running a group, I'll typically ask all the questions that folks don't know where to ask. All right, I see somebody text. You guys are texting already. All right, you guys are pretty quick with that. All right. Identify investment goals. Are you going to do, is it a short term investment or is it a long term investment? You're going to determine whether the focus is on short term profits like fix and flip or long term gains like rental income, property appreciation. You're going to have a conversation about the investment scale. And by the way, if you guys don't have to remember all this, I'm reading just straight from the lesson. So if you guys are trying to take notes, it'll all be here. Investment scale. So you're going to decide on what scale of investment, such as the size and type of property. So you want to do single family homes, or multifamily units, or commercial properties. Geographic focus. Where are you guys going to do it at? So you want to identify target locations or markets based on your research and potential ROI, return on investment. Now, I'll invest anywhere in the country. I'm more comfortable investing in places where I already have a team. It's going to save me a lot of trouble. When I don't have a team, if I've got to go in blind, and I've done that, I think 4 out of the last 7 deals that I did were I went in completely blind. It just requires more due diligence and more of my time, right? You got to define the roles and responsibilities. This is where people mess it up. Assess each member's skill and expertise to assign roles, right? Who's going to manage the project? Who's going to manage the financing? Who's going to take care of marketing? Who's construction oversight? All of these things. And I'll give you each role that is typically required. It may be one person doing 4 or 5 things, right? But you at least need to have the conversation. And the fourth thing you need to talk about is risk tolerance and budget. That's a big one because everybody wants to participate in a group, but who's writing the checks and for how much? Is somebody going to be a credit partner? Is somebody just coming in sweat equity? How are we doing that? That conversation needs to be had. So risk tolerance and budget. So for risk assessment, discuss and agree on the group's risk tolerance level. This includes understanding potential risk and how much the group is willing to invest in high risk versus low risk properties. Now, by the time you are looking to invest in a group, you should already be able to assess a deal. Somebody in the group needs to be responsible for determining whether an investment is worth moving forward on. Right. So one person in the group needs to at least understand 4 data points, right? How to assess a deal. Everybody that follows me should have that guide somewhere. So the 4 data points guide, we look at a subject property and we ask the 4 questions. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? Once we have the answers to those questions, someone in the group needs to be able to interpret, is this property or deal in our buy box? All right. Develop investment criteria. So I'm talking about property selection criteria. So define specific criteria for property selection, like condition, price range, potential for appreciation, and renovation requirements. If you run the 4 data points, that will happen automatically because it forces you to look at a subject property and ask the appropriate questions. What does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? Now, again, we're still in the first meeting. These are just all conversations that need to be had when we're putting a group together, right? If these conversations are not had, it's going to be a lot more difficult. So moving on. Legal and operational structure. Legal entity. Decide on the legal structure of the investment group, LLC, partnership, whatever it's going to be. So it's going to protect personal assets and clearly define ownership percentages. I'll typically use an LLC for something like this because I'm going to dissolve it right after the project is done and over with. All right. So I'll typically do an LLC for this. In the LLC, I'll draft an operating agreement and it's going to outline the group's objectives, roles, profit sharing, decision-making process, and conflict resolution mechanisms. One of the things that protects these groups is being able to resolve conflict and have it on paper. And my operating agreements, I have full control over all the decision making, all right? Or I don't get involved. All right? If there is somebody else that I feel has more expertise in what it is that we're doing, for example, let's say I wanted to do an investment that had to do with something like a group home or something like an assisted living home. I would bring in a consultant because there are certain compliance requirements on those business models that I may not be 100% aware of. So I bring I bring in a consultant for that. All right. Now this is important. When forming a real estate investment group, it's essential to consult with qualified professionals. Amen. They can help you decide on the appropriate legal structure like LLC or partnership, or protect personal assets and define ownership percentages, just as I just mentioned. Additionally, they can assist in drafting a comprehensive operating agreement that outlines the group's objectives, roles, profit sharing arrangements, decision making process, and conflict resolution mechanisms, ensuring a solid legal and operational foundation. Folks, don't be afraid to bring in a consultant. And if you're going to invest in a group, make sure that you have all of your paperwork in order, because if these are people you care about, right? And we're talking about investing with friends only, not soliciting money to invest like syndication. It's going to preserve the relationship, right? Now, we are still in that step one. I'm listing all of the conversations you need to have with the group prior to moving forward. And I'll do a recap after I finish this section. Now, strategic planning. So, market research. So, you got to conduct thorough market research to identify potential investment opportunities and understand local real estate trends. Now, when it comes to market research, I put a lot more market research the more doors that I'm purchasing. So, for example, let's say I'm looking at a 15 unit apartment building. I'm going to do a little bit more market research than I am if I'm just doing a single family home. Why is that? Well, because I got 15 doors I have to fill. If I'm doing a single family home, I just got one door I have to fill. So, if I'm looking at just a single family home, I'm more interested in the four data points around that applies to that specific home, not the neighborhood, not the city, not the zip code, that particular home, right? So I'll pull up that address and I'll ask four questions about that particular address. What does it cost, or what am I willing to pay? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? All right. Now, if we can get up to some more shares, we're at just a few on TikTok. Once we get up to 30, I'm going to throw in something special for you all. If I can get 30 shares, I'm going to throw something special for you guys that text the word yes to 702 710 8030. I'm going to throw something extra in. And by the way, folks, this is stuff that the stuff I'm giving you right now is you would probably have to take a workshop or something for this, and it would cost you something, right? I know that because I've done workshops on this and have been asked to speak at workshops on this. So I'm giving you the blueprint for investing with a group. All right. Now we're still in step one. All of the conversations got to have performance metrics. So key performance indicators. Now keep in mind, this applies whether you guys are just flipping a house, which is something very, very simple. Thank you, Nikki, for sharing that. Whether it's something real simple, or whether you're doing a major project. Okay. All of this applies. So some of the things that I tell you, you may think, well, this may be a little overkill if we're just flipping a house. But no, the same thing applies. If it's information you don't need for your particular project, it's better to have the information and not need it than need the information and not have it. All right. So we need to establish some performance metrics. So KPIs to measure success of investments. Some of the typical KPIs are return on investment, time to flip, profit margins, rental income, and we should be doing regular reviews throughout the project. So we're going to schedule regular meetings to review progress, discuss challenges, and adjust strategies as needed. That's a really big thing. You got to understand, just because you've committed to a project and you are already on the project, you have to continue monitoring it to determine whether or not you need to pivot. For example, when we are, let's say we're going to do a rehab and rent, which means we're going to buy a property, we're going to rehab it, make it worth more than we bought it for, and then we're going to leverage that. But instead of selling it, we're going to leverage it, and we're going to bring in permanent financing. We're going to do a cash out refinance and keep the property occupied and cash flowing. Okay. So now, what happens if during your project interest rates continue to go up? I had a commercial project. I'm still on it now. Interest rates went up 4 times in 6 months, give or take. Well, if the interest rate goes up, that's going to impact your ability to do your cash out refinance. And if because the cost of money is higher. And when the cost of money is higher, your monthly obligation to that mortgage is higher. So it may get to a point where the projected rental income is not enough to service that debt, because that monthly obligation is higher than the income the property generates. So we may have to pivot. And if we have to pivot, that means, look, we're not going to be able to do the cash out refinance now because the mortgage payment is a lot higher than we anticipated when we started due to higher interest rates. So now we got to sell the property. Well, that's a very simple decision, right? You sell the property, you can get all the equity out when you sell it, but there are some decisions within the process that need to be addressed if you're not going to exit the same. So if I was going to keep this property as a long-term hold and rent it out, I'm not going to use super high-end materials. So if I decide, hey, we're going to sell it, hey, those $1,200 countertops we were going to put in, let's go ahead and put the $5,000 countertops in because now somebody is possibly going to purchase this as their forever home. So there's got to be some performance metrics. There's things you got to be on top of when you are looking at a project. And it's basically really just two things: the cost of money, right? And what comparable properties are doing in the neighborhood, right? So data point number 3 out of the 4 data points, remember, what does it cost? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? Data point number 3 is what's it going to be worth when I'm done? Everything hinges off that number. Everything hinges off what it's going to be worth when I'm done. That number can change. I'm just talking out loud, folks, or thinking out loud now. That number can change with transactions in the neighborhood. So if transactions in the neighborhood tell us that our property will probably sell for about 300,000 when we're done, interest rates go up, guess what? People can afford less house. So the property values are impacted in the neighborhood. They start to get reduced. We thought we were going to sell it at one price. Now we got to sell it for less, or now we're going to refinance it for less. That's something that has to be taken into consideration. So somebody's got to be responsible for looking at that. Contingency planning, risk management. So develop contingency plans for potential risk. That's one of them, such as market turndowns, budget overruns, or delays in renovation. Folks, you can do everything right as a real estate investor, and things will still go wrong. All right, there's always going to be things beyond your control. There's always inherent risk to investing in real estate. It's my job to teach students how to understand those risks and see how risky it is for what they're trying to do. And then we put things in place so they can mitigate those risks. All right. So that's just step 1 in investing with a group. I'm going to do a quick recap, and these are all of the things that need to be included in that first meeting. So let's call this the meeting agenda for that first meeting with your group. All right. So you got to identify investment goals, define roles and responsibilities, determine risk tolerance and budget, develop investment criteria, legal and operational structure, strategic planning, and I've got subtext for all this. I just went through all of them, so I'm not going to go over them again. Establish KPIs, which are key performance indicators. That's just data that we look at to see how we're doing, how we're performing. Have a communication plan. So that's establish clear communication channels for regular updates, decision making, and problem solving. You can just put meetings on the calendar. I usually suggest weekly meetings, right, in the beginning, especially during the project. And if you guys are doing a rehab, those weekly meetings should include your contractor or the contractor's representative. Trust me, it will save you an enormous amount of money. Contingency planning, risk management, these are all topics that you need to have. Now, we're going to get into step 2. Now, is there any questions about any of the stuff that I went over so far? Mm-hmm. All right. So let's get into step 2. Now, we're just talking about investing with a group. Remember, these are familiar people. These are people you have a pre-existing relationship with, right? Thank you to the couple folks that shared the room on TikTok. All right. Step 2, you got to form a legal entity. Okay. So when deciding what entity to form for real estate investing, there's several factors to consider. I'm not here to tell you which entity is better than the next. I say talk to a qualified professional. I use different entities. I'll typically use LLCs for the temporary stuff, but I'll tie those in with C corps and some other entities in my personal wealth system, right? My personal structure. But for the quick fix and flips, I'll go ahead and use an LLC, and then we'll go ahead and dissolve the LLC. So they're just disposable. Now, always talk to a qualified professional. If you guys talk to a qualified professional, whether it's a CPA and tax attorney, uh, tell them you want to accomplish 3 things. I always tell them I want liability protection, tax favor, and anonymity. So in everything I do, I want to accomplish those three things. Now you tell me how best to be structured in doing that. Okay. So we're not going to get into the different entities, but when we're looking to form a legal entity, these are all the things we have to consider. Liability protection. So assess the level of personal liability protection each entity offers. For instance, an LLC typically provides strong liability protection, shielding personal assets from business debts and legal actions. Keep in mind, everything has its use. Okay, there's no bad entities. There's just bad investors. Now everything has its use. So when you hear LLC, C corp, keep in mind that's never going to be the end all be all because it depends on how you use it. All right. I've well, I'll leave it at that. The next thing you have to consider is the tax implications. So understand the tax implications of each entity type. Different structures, such as LLCs, partnerships, and corporations, have varied tax benefits and obligations. Consulting a tax professional can help determine the most tax efficient structure. Keep in mind, when you're investing with a group, there's two structures, there's two legal entities you have to consider, one for the group itself, but also one for the participants. So I may want to be a part of a group investment, but I may not want to do it under my personal name. So I'll have my investment company be part of it. So James Street Capital may show up on the operating agreement or whatever entity that I want to show up. So talk to a professional, qualified professional. Management and control. Now these again, I'm just going over things to consider when you're trying to determine what entity to use. So consider how management and controls is handled. Some entities allow for flexible management structures while others require more formal governance. Ensure the chosen entity aligns with the group's desired management style. Again, I'm not typically not reinventing the wheel. If I'm using an entity that needs to be disposable, I'll use an LLC. If something is going to fit more permanently into my structure long term, then I'll use LLCs used differently, C corps, and I'll have a kind of a land trust, and all of this stuff will tie together. Profit distribution. Evaluate how profits and losses will be distributed among members. Entities like partnerships and LLCs offer flexible profit sharing arrangements. This can be tailored to meet the group's needs. Again, just something to consider. And if you guys are actually moving forward with investing in a group and you have this guide, have it with you when you're talking to a qualified professional. All right. Formation and maintenance costs. I don't see how these folks are, well, I can see it's a bad decision, how folks have every single property in its own LLC. That's a lot of paperwork. All right. Most of the time I'll use a land trust and then have the beneficiary of that land trust one of my LLCs. But again, talk to a qualified professional. Maintenance costs is something to take into consideration, but it's definitely not something that you want to skimp on if it's going to be the best structure for what it is that you're trying to do. Operational complexity. Consider the operational complexity and administrative burden of each entity. Some structures may require more detailed record keeping, reporting, regulatory compliance. That's a big one for me. Right? But if it has to be done, it has to be done. I'm not going to have a subpar legal structure because I don't want to do the paperwork. But this just reinforces that we need to understand what questions to ask and what things to consider when we're trying to choose an entity for our group investment. Future needs and scalability. Think about long-term goals of the investment group and whether the chosen entity can scale with the group's growth. Some entities are easier to expand or dissolve if necessary. Now, that's a big one for me. I don't do long-term group projects. If I have a group project that went long-term, that means it's going bad. It's not long-term on purpose, right? But that's something that's big for me. And the reason why I don't do group projects long-term is because those relationships have to go long-term. And those relationships, that it could be a slippery slope, all right, because you're obligated to these folks. And I tell you, just be very careful about long-term relationships when you're doing investment groups. I've seen families torn apart. I've seen friends stab each other in the back. I've seen things go really, really bad. Not with me, but I've seen it. All right, step 3. So we have multiple steps, right? The first step is define the group's goal and structure. And I outlined all of the conversations within that first meeting that you need to have. Okay, literally every conversation you need to have. Step two was form a legal entity. So I didn't say which one you should form. I just told you all of the things that you should consider when trying to determine which entity that you are going to be investing with. And step three, financial planning. This is where we are now. Now, again, if you're just you got a couple friends and you're going to flip a house, maybe it doesn't need to be this complicated. But when you start getting into the big numbers, it's better to understand how to operate on a much larger level and scale it down than get a larger opportunity and not be able to manage it. Let me see. I texted yes and didn't receive anything. Of course you did, man. I'm still here. Why would you want me to stop the live stream and get it to you? That's gonna come up on my database. I'm gonna have you guys. I'm gonna have it sent out to you, brother. This generation, but they want it right now. I just text. I didn't get. Yeah, so don't worry. You'll get it today or tomorrow. All right, financial planning. When engaging in financial planning for real estate investing groups, there's several additional factors we got to consider. Now, if I'm doing a group, and let's say there's 10 of us in this group, ideally, and this is if they're not my students, ideally, I would have somebody in charge of the financials, right? So the first thing, budgeting. Now, when you're talking about budgeting and you have a group, please don't put somebody in charge of budgeting that doesn't have their own finances in order. I'd only invest, Jason says, I'd only invest long term with my wife. Okay. But look, that's one of the things we look for. If I have an investment group, and I'm doing it personally with people that I personally know, I put clauses in there that, well, not clauses. I have one particular clause that basically says, hey, look, this is your investment group. It's not your wife's. So make sure you and your significant other have these conversations prior to coming in, because outside influence can be detrimental for the group. Trust me, folks, I've seen it all. So I'm trying not to laugh. All right, so budgeting. Create a comprehensive budget that includes acquisition costs, renovation expenses, holding costs like property taxes, insurance, and utilities, and selling costs. And make sure to account for contingencies to cover unexpected expenses. That's pretty much your scope of work. And there's tools for that. You guys in our real estate family, my students, I have a tool for you guys to be able to just fill in the blanks on that. So that should get you in the right space. Cash flow management. Now, folks, we're on step three. And a lot of this stuff isn't really sexy, right? It's not, this could be a lot of dry material, but now we're talking business, and we do the things we have to do in business so that we can do the things that we want to do. This is something that has to be done. There has to be financial planning if you are investing in a group. Make the most responsible person responsible fiscally and have them in charge of this. So cash flow management. So ensure there's sufficient cash flow to cover ongoing expenses throughout the investment period. So it includes not only renovation costs, but also holding costs until the property is sold. Now, there is something that it's a word that you're a phrase that you probably don't want to hear. And when you hear it, you know it's going to cost you something. It's called a capital call. A capital call is when we need to raise more money for a particular thing and it's usually something didn't go according to plan, right? So if you have your own investment group and you hear the words capital call, that means we got to have another meeting and we got to raise some more capital within the group. Okay. Good luck getting a warm greetings for capital calls. All right, return on investment analysis. So perform a detailed return on investment analysis. Most people don't know how to do that, but I'll show you. To ensure that the projected profits justify the investment. Consider different scenarios and sensitivity analysis to understand how a change in costs or sale price, how a change in cost or sale price can impact the return. I'm just going to say this. You don't have to do a big complicated analysis unless you're doing a multifamily commercial project. If you're just flipping a house, there's 4 questions that you're going to need to ask and answer. And that could be the gist of your analysis. 4 data points. What is the cost? What is the cost to fix up? What's it going to be worth when I'm done? How much income can it generate? The answers to those questions are going to tell you whether it's profitable and whether or not you should move forward or not. All right. Credit scores and financing. Be aware of the credit scores of group members. This can impact the ability to secure favorable financing. So work to improve credit scores if you're going to be investing with that group long term, and do it before you start applying for financing. I'll do kind of a credit check, and your credit as a real estate investor is going to be all over the place because there's going to be situations where you go over budget on your business credit cards. Well, what happens? You still got to finish the project. What happens when you start switching over to personal credit cards? Well, utilization impacts your credit score, not from your business credit cards because that utilization doesn't go against you, but your personal credit cards, you use them up, credit score goes down because your utilization is high. All right. These are all conversations that need to be had. So in my particular group, we'll have credit partners. I'll talk to the lender that we're using and say, hey, look, we got a few credit partners in here. If it's not me, we got a few credit partners in here. What are the ownership percentages that you require? Yeah, buddy. Go talk to Mama Gloria. Okay. Oh, the days of being 3 years old where you could just walk around in your underwear. Thank you, brother. That little man be walking through the house like he got a job. Hey, is there any cereal in there? All right. All right, where were we? So credit partners. I talked to the lender to say, hey, how much ownership should our credit partner have reflected on the operating agreement so that we have a smooth, ride forward? And they'll say, well, if you have credit partners, I'll typically give them the credit situation for everybody in the group. And if we have to reposition, I'll let the lender determine based on their criteria how we reposition. Just because somebody has more ownership does not mean that they get more of the profits because my operating agreements are pretty complex. So ownership does not equal profit share. It could be lopsided. There could be somebody with 1% ownership that gets 80% of the profits. So it depends on how we have it set up. All right. Interest rates, loan terms. That goes along with the same conversation. So just pay attention to interest rates and loan terms. Securing the best terms can be significant with respect to how it impacts the profitability of your investment. What you guys will run into is a lot of people are doing these business purpose loans. You don't need a NMLS license to do business purpose loans. So hard money lenders, and they'll broker these. And a lot of these folks aren't investors. So what you're paying, and this is reflected on what we call a term sheet. What you're paying is going to be the points from the broker and then the points from the actual lender. Now, I'm not saying don't do that because many times it's necessary. When people come to me for lending, mostly just my students, when they come to me for lending, I'm looking at their deal as an investor first, and then we're looking into the term sheet and all the other costs associated with it. All right. So just be careful when you get a term sheet, just read it, read the entire term sheet, and go ahead and plug those numbers into your projections. All right. Tax planning. Please consult a tax professional to understand the tax implications of your investments. This includes understanding capital gains tax, property taxes, and possible deductions related to investment expenses. Now, this has to be done twice. I will do it as if I'm facilitating the group, if I'm taking the lead, I'll do it for the group. But the participants in the group need to do it on their own behalf, right? What are the tax implications when they get paid? All right. So it has to be done twice, one for the group, but also each individual that's a part of the investment group should be doing it on their own to see what tax implications they're going to be. I was about to say victim to. Yeah, we're all victims when it comes to taxes. All right. Accounting and bookkeeping. Implement a robust accounting and bookkeeping practice to track all income and expenses accurately. This can just be an Excel spreadsheet. There's software that does this. There's a bunch of tools and things that does this. If you're just flipping a house, it doesn't need to be that complicated. Just record everything, and then I would probably regroup every few weeks just to make sure all of the accounting is where it needs to be. Financial reporting. This kind of goes under communication too. Establish regular financial reporting practices to keep all group members informed about the financial status of the investment. This includes income statements, balance sheets, and cash flow statements. Sometimes you're not doing, well, it depends on how big the project is. Again, if you're just flipping in a house, you're probably not going to have all that. And this is also I'm articulate it this way. People that have never invested before, and this is one of the setbacks of putting a group together with people that are not savvy investors. And that's also why, when you start getting into syndication and these large scale capital raises, this is why it's governed by the SEC, right? The Securities and Exchange Commission, is because people that are not savvy will call you every 15 minutes asking about their investment, right? Just if you're going to lead one of these groups, just take that into consideration. You will have to have a lot of conversations and give a lot of updates that are identical and exactly the same for people that don't understand how this works. Now, that's not their fault. So it's up to you if you're leading the group, just like it's up to me to manage expectations. Okay. All right. Risk assessment and mitigation. Identify potential financial risks such as market fluctuations or cost overruns. Folks, that goes with everything. Those are things that are going to be beyond your control, right? You just got to develop strategies to mitigate those risks. For example, if you're flipping a home, one of the biggest risks are your ability to exit. What's the value of the home going to be when you're done with the project versus what you projected at the beginning of the project? All right. And what can change is transactions in the neighborhood. If they go up, that's to your benefit. If those sale prices go down, it's to your detriment. So you have to be able to see that coming. So you want to continue to stay up on transactions in a particular area because they are going to directly impact your value. All right. Exit strategy financial. So plan for the financial aspects of your exit strategy. This includes estimating net proceeds from a sale after accounting for closing costs, real estate agent fees, and any remaining loan balances. Just saying, run the numbers when you're exiting, right? People that are investing in a group, they want to know how much they're going to get paid. That's all I care about when I'm investing in a group, right? For the most part. So just make sure that you have those numbers as accurate as possible and keep an open line of communication with the folks in the rest of the group. Profit distribution. Clearly define how profits are going to be distributed amongst members. Do this in the beginning. That's part of that first conversation. All right, that first conversation you ever have should deal with profit distribution. Okay. Now, and try to stick to it as you reach your exit. All right. That was step 3. So I'm going to do a recap on all of the steps when investing with friends. Keep in mind, I keep saying friends. These are people you have a pre-existing relationship. This is not you putting deals together for the general public. You can get in trouble for doing that because it's heavily regulated. So there's a lot of compliance that goes along with that. All right. Step 1 was just having that first conversation, right? Identifying investment goals, defining roles, risk tolerance, budget, investment criteria, what legal structure are we going to form, strategic planning, establish performance metrics, right? What data are we going to look at to see how we're performing, having a communication plan and a contingency plan. That's step 1. Step 2, form the legal entity. And then I went over all of the things you need to take into consideration when forming that legal entity. Liability protection, tax implications, management and control, profit distribution, formation and maintenance costs, operational complexity, future needs and scalability. All right. Step 3 was financial planning. I would typically, if I'm doing a larger group, I'm putting one person in charge of financial planning. And within that conversation, we're talking about budgeting, cash flow management, return on investment, credit scores and financing, interest rates and loan terms, tax planning, accounting and bookkeeping, financial reporting, risk assessment, exit strategy financials, profit distribution. Okay. That's that conversation in its entirety. Now, step 4, market research, property selection. Now, I'll say this again because, I get the question asked quite a bit. What's a good market, right? I don't necessarily look at the market as a whole. There's just certain types of investing that are prevalent in certain markets. So there's good deals in every market and there's bad deals in every market. Now let's take where I live, the San Francisco Bay Area. And within the Bay Area, I live on what we call the peninsula. It's expensive. Doesn't mean you get a lot of value for what you pay. It just means it's expensive. Is it worth the expense? Absolutely not. All right, absolutely not. It's highway robbery out here. But if I'm out here and I'm going to get a fixer upper, that's going to cost me $1,000,000. That's a fixer upper is going to cost me $1,000,000. Now, when I bring in some rehab money, let's say I bring in another $400,000 to fix it up because labor costs are also more expensive out here. Okay. And let's say now I made it worth $2 million. I'm in 1.4. I made it worth $2 million. If I sell it, that's 600,000. If I do a cash out refinance, then that is a $1.6 million cash out refinance. I'm in for 1.4 million. That means I can pocket 200,000 less fees. The problem is that final $1.6 million mortgage is going to be higher than the rental income that the property generates. So the Burr method doesn't work out here. So we're only doing flips out here. Does that mean that there's no deals out here? Well, yeah, you can make $300,000-$400,000 on a flip out here, even more than that in some cases. But it's going to require a lot more capital to secure it unless you do something creative. So market research, I don't just look at an entire market unless I have a lot of doors to fill. If I'm buying a 20, 25 unit building that's vacant and I'm going to rehab it, I got to fill 25 doors. I need to know that there's enough people out there with the demand for housing to be able to make that successful. If I'm just doing a single family house, single family home, it's not going to be that detrimental to do all the market research. I'm just utilizing the 4 data points because the 4 data points apply to specific properties, right? That house, not that zip code, not that city, not that market, that house. Okay. So identify your target market, set your criteria, and find some properties. You can use multiple listing services. You can use real estate agents. You can use wholesalers. You can use online platforms to find potential properties. You guys that are real estate investors are eventually going to have a system in place to find off market properties. It's a marketing system. And you guys are in our real estate family. If you're not there yet, I'll teach you how to do that. I'll help you set it up. All right. And you got to start marketing to people. Marketing costs money. All right. But you're going to have to do some market research and property selection. That's step 4. Step 5. Now we're talking about investing with friends. We're on step 5, due diligence. Now, this is when you found a property. There are some boxes that you need to check. And believe me, I have them in checkbox form. All right, come on up, Ron. I see you got a question, brother. Let me get Ron's question and we'll jump back into it. All right, Ron, you up here? That's Ron on Clubhouse. All right. He had his hand up. I think he left. All right. All right, so we'll jump back into it. So now due diligence, this is step 5. Now you found a property. Now we got to make sure that it's worth moving forward. All right. Thank you, folks that shared the TikTok live. Property inspection. Now I give you a list of due diligence that you and the group need to utilize. All right. So when I hand this lesson to somebody, it's everything that they need to know about investing with the group, not just the group itself, but once they're off and running, how to manage the actual project. So step 5 is due diligence, property inspection. Hire a property inspector. Hire a professional inspector to evaluate the property's condition, including structure, foundation, roof, electrical systems, plumbing, HVAC, and other critical components. You got to know what you're buying. Okay. Identify any necessary repairs or renovations and estimate the associated costs. Now, I will typically teach people that are doing this about the scope of work. So what happens is if I am coaching a group, once we've secured the property, not secured, we haven't closed on it, but once we put in an offer and the offer gets accepted, now we're in the due diligence phase. Anytime you put in an offer on a piece of real estate, on that offer, there is a section that talks about the inspection period. The inspection period is basically the due diligence period. That's the time you do all your buyer beware stuff. Okay. So all the buyer beware stuff. Now we're making sure that this property is worth moving forward now that we have access to it and we're already in contract. So hire a professional inspector. Okay. If you're a seasoned real estate investor and you've done, 10, 15 flips, whatever it is, and you're familiar with this area and labor costs and code requirements, maybe you can get around an inspector and just get all of the vendors that are going to be working on the property to come and evaluate these systems and give you a cost estimate. All right. The next thing, check box, title search, ownership verification. Anytime I do a project or any type of real estate, I open up escrow. Opening up escrow means you enlist the services of a third party company, and they're the ones responsible for making sure everybody is doing as agreed. They're also responsible for doing what we call a title check, and they'll go ahead and conduct a title search to verify the property's legal ownership and ensure there's no liens, encumbrances, or legal disputes associated with the property. And they're also responsible for issuing title insurance to protect against potential title defects. All right, that is very, very important. I also open up escrow 100% of the time because I never send money directly to the person on the other side of the table, right? Whether it's a seller, whether it's a wholesaler, whatever it is, all money goes through escrow. The third checkbox is the financial analysis. Now we're on step 5, due diligence. So this is our offer's been accepted and we are in our inspection period for this particular property. Now, financial analysis, so I review the property's financial history, including past sales, rental income, and operating expenses. I review it, but I don't always believe it. People can fabricate a lot of these documents, and I take it with a grain of salt. I do my own projections based on the 4 data points. All right. Analyze the potential return on investment by comparing purchase price, renovation costs, holding costs, and projected sale or rental income. I do all that before I'm committed, right? Checkbox 4, market analysis. Research a local real estate market to understand current trends, property values, and demand for similar properties. I will typically hire an agent if I'm going to do a flip and sell it. Even though I'm a licensed real estate broker, I could sell it myself. I can't justify the time in doing that. So what I'll do is typically hire an agent. They're a part of that MLS. They've already got the relationships. They've already got systems in place. So I'm more than happy to enlist an agent. I'll take a referral fee from it, but I'm more than happy to enlist an agent to be able to help me in that area. Checkbox, next one, zoning and land use regulations. So verify the property's zoning designation and land use regulations to ensure the intended use. Now, if you're building from the ground up, this is really, really important. If you're just doing a value add, meaning you're taking an existing structure and you're improving it, it's not as important because as long as you're not adding any, rooms or changing the use, it's not as important. The only thing that's important is checking to see what code requirements you have to, we'll call that get triggered. Well, this is what I mean by that. So the code requirements are what they are, but there's code requirements that have changed after properties were in existence. So what happens is a lot of those properties get grandfathered in and aren't required to meet some of the new code requirements unless you improve the property a certain percentage, then it's going to trigger being up to date on all the code requirements. That's what I'm referring to. All right. So that's something you want to check. You want to do an environmental assessment. This is a natural hazard disclosure report. There's a company called Property ID for $99. They will do the entire, they'll give you the entire package, right? So you want to conduct an environmental assessment to identify potential environmental hazards, such as soil contamination or proximity to flood zones. Folks, that is a big one. I've overlooked that before. I purchased 4 lots, but 2 of them were on like 13,000 square feet. And these lots were, we were going to build duplexes on them. And then, yeah, I messed this one up. We were going to do duplexes on them, and we went down there and we were going to clean them. We were cleaning them out. And I don't know if you know that I don't like snakes, right? So we're cleaning these properties out, and I got some students down there, and we're going to make a learning opportunity out of this. So we went down there, looked at another project, and then we were doing a clean out on this project, and we started running behind, and we've got the big dumpsters out there, and so I ended up hiring some more people towards the end of the day to come out and help us so we can get this thing wrapped up. And 2 of the guys were in the house, and they came out. They were like, "Oh man," I was like, and I was going to go in after them. They was like, "Hey, be careful, man. We saw a snake in there." I'm from California. I'm not from down south. I'm not from any of these places where snakes are common. If I see a snake, I'm moving. There ain't no, oh, we saw a snake and let's get back to business. I don't mess with that. So I was like, the day is over. And I had the houses bulldozed. So there's ain't gonna be no snakes now. So I had the houses bulldozed. Now, come to find out, way back there, and you can't see it, so you don't know it's there, and it's all dried out, right? Way back there behind these lots, there's a creek back there. So what happened is now, because we're going to rebuild, and we ended up deciding to build fourplexes, it's going to be more expensive to build because we have to be in compliance with the zoning requirements for being that close to a creek. And it's going to be a lot more expensive than, we budgeted for it. We should still be able to do it, but that was on me, right? Now, luckily, we paid cash for these lots, so we dropped $100,000, and there's no debt against it, but we're still responsible for mowing it because that's a code violation if the grass gets too high. And there's a total of 4 lots. It cost me almost the lots are so big. It cost me almost $2,000 just to mow, just to cut all the vegetation when it grows. So just because there's no debt on a property, folks, doesn't mean you're not obligated to other expenses. So an environmental assessment. Right? And again, that's my bad. It is what it is. All right, legal compliance. Now, we're in step 5. We're in the due diligence phase. We put an offer in on the property. The group did. It got accepted. We're in the inspection period, and now we're doing the due diligence. So property inspection, a title search, financial analysis, market analysis, zoning and land use regulations, and environmental assessment, which is what I just talked about, legal compliance, ensure the property complies with all local building codes, safety regulations, and occupancy requirements. Verify all necessary permits for renovations or new construction can be obtained. This is where when people are investing in residential and they get into multifamily commercial, that's the one that hurts them. What happens is once you get into multifamily commercial, 5 units or above, there's a whole different set of code requirements that are in place that aren't for 1 to 4 units. And one of the biggest ones, the more expensive ones, are fire and life safety. Okay. Now, imagine this. We had 2 lots. So there were those 2 lots by the creek that I just told you about. And then across the street, there were 2 more vacant lots. Then what we were going to do, we were going to do fourplexes on each lot, and then we were going to combine the lots. Now we got 8 units. Well, why would we do that? Because it's way more valuable, even though it's 2 fourplexes, which is still 8 units. But if we merge those lots, it's still 8 units, but now it's considered multifamily commercial. And multifamily commercial is valued based on the income that it generates and not what similar properties are selling for. And because this area is near a military area, as a fourplex, we're going to have some of the newest product. What's up, 10K? We're going to have some of the newest product, but there's a ceiling on our value because there aren't products in the area that are being built so that our value increases with those transactions. But if we were going to make it multifamily commercial, it doesn't matter what sales are in the area because our property is going to be valued based on the financials. And as long as we keep managing rents and reducing expenses, the value of the property is just going to continue to increase. But the reason we weren't able to do that is because we had 2 fourplexes. If you have 2 fourplexes already built and then you make an 8 unit, right? You consider it an 8 unit, even though they're not touching, you are still responsible for meeting all the life and safety requirements because it's now multifamily commercial. Well, we can't meet all those life and safety requirements because the fourplexes would have already been built. That means we had to go in there and I'm talking about fire suppression systems, alarm monitoring systems, fire rated doors, all of these things that would have to be in place. And it just wasn't worth it. Right. Is that Dwayne? I see Dwayne. I see a Dwayne in there, but I don't know if that's the real Dwayne. I don't know if that's the real Dwayne, but all right. All right. So that's something that's important. If you're going to be doing value add, meaning make a property worth more than you bought it for, then you are going to have to make sure that you understand what comes along with that. That is very, very important. Okay. So legal compliance, tax assessment. Review the property's current and past property tax assessments to understand your tax obligations. You want to understand what the tax rate is before you buy it. Consider the impact of potential tax increases or reassessments on your investment. Now, when you do the natural hazard disclosure report, Property ID is the company that I use. Um, they'll have that in there. So if there's any other tax assessments that need to be taken into consideration, they'll research all of that for you, right? But also keep in mind that taxes get reassessed upon transfer. So if you're doing your budget for your property and you're including the property tax amount that the owner, the current owner, or the person selling it to you is realizing, that's not going to be accurate, because as soon as the property changes, it's going to get reassessed based on the purchase price. So understand that. Utility and service verification. Verify the utilities. Verify the availability and condition of essential utilities like water, sewer, gas, and electric. Assess the quality of local services, schools, transportation, and emergency services. I do look at schools. I look at schools because depending on what type of units that I'm building, if I'm not utilizing, let's say a 3 bedroom. Okay, I gotta pick the highest and best use, right? Let's say I got a lot trying to figure out what to build. Well, it's gonna cost me less to build a 2 bedroom, 2 bath, but if I build a 3 bedroom, 2 bath, now I can bring in families with kids, right? And families with kids are longer term tenants, typically, statistically. And if there are no good schools in the area and I build a 3 bedroom, 2 bath, then there's probably going to be some folks out there that would have rented but didn't, because no one wants to put their kids in, you know, a hood school where they got metal detectors and all that other stuff. You guys know what I'm saying. All right. Insurance requirements. Determine the insurance requirements for the property, including liability, property, and flood insurance. Obtain quotes to estimate ongoing insurance costs. Now, this is something you do during the due diligence period, but you're not going to be able to get financing without this. So if you're using a hard money lender, they're going to they're going to acknowledge the receipt of your application, right? You go online and apply, upload the purchase agreement. They are going to respond to your application with an acknowledgement. And then somebody from their office is going to respond, and they're going to give you a list of conditions. Those conditions are going to be in 3 categories. They want to know about you, they want to know about your experience, they want to know about the asset itself, and they want to know about the entity. So, as far as what they want to know about you, they're going to want to know how many you've done. How many of these projects have you done? And they're probably going to attach a spreadsheet, which is a schedule of real estate owned. It's going to be, they're going to already have it. It's just a template. And you just put in all of your transactions within the last 36 months. Or some say the last 24 months. There's a few that say the last, 48 months. All right. So that's you. Then they're going to want to know about your entity. They're going to look at your articles of formation. They're going to want to see a certificate of good standing if that entity has been in place for over a year. If it hasn't, you're not going to have that. So that you would just acknowledge that. And maybe a few other documents about your entity. Then they're going to want to see about the project itself. The project itself, they're going to want to see your scope of work. All right. They're going to want to see your scope of work and your budget for the project. Scope of work typically is your budget, but I usually have 2 versions of the scope of work. One is a lot less detailed. The less detailed one I submit to the lender, same dollar amount for the work, but the more detailed one I'm attaching to my contract so the contractors can sign. So that's a lot more detailed. Okay. And another requirement, they're going to want to know, all right, who's the escrow company? Who's the closing company? What's their contact information? Because they're going to need to communicate. And last but not least, they are going to want to know about the insurance, which you don't have yet. And that's them telling you you need to go get insurance. Okay. So you're not even going to get financing without insurance. Doesn't mean you have to pay for it up front. You can get what we call your insurance binder. They'll put it into escrow and they'll make it a part of your closing costs. All right. Now, again, we are on step 5, the due diligence. We talked about the property inspection, title search and ownership verification, financial analysis, market analysis, zoning and land use regulations, an environmental assessment, legal compliance, tax assessment, utility and service verification, insurance requirements, and now we're at existing leases and tenants. But let me go back up to utility and service verification. Part of my due diligence is getting an understanding of how the building is set up, right? Is it master metered or is it sub metered? And that is something you have to pay close attention to, especially when you are investing in multifamily commercial. Are the tenants paying their own utilities, or are you paying it and billing back the tenants? The reason why that's important is because if the tenants are paying their own utilities, you're good to go, right? You only have to pay the common area utilities. But if you are paying the utilities and trying to bill back the tenants, then you're going to have to adjust your lease agreement to enforce occupancy standards. Because if you bill back a 2 bedroom based on the 2 people that live there, and they've got 6 people living there, well, guess what? You're billing them back for 2 people, but they're consuming a lot more utilities. Right? So that's language that's going to have to be in your lease. That's why it's important to take that into consideration. Otherwise, you got people that are, they open up the front door and try to heat up the whole neighborhood with your gas. And all right, do I sound triggered? Yeah, that happened to me. All right. I had this one property. I was like, "Oh, I'm making a killing." I was working with some some nonprofits, and I was doing some transitional housing, and I was making so much on the rent. I was like, it only cost me about $700 a month to own it, and I was bringing in like 2150 a month in rent. So I was like, "Yeah, I'll cover utilities." And then I soon realized that them tenants was trying to heat up all of Missouri with the with my power and electricity and gas. All right. So insurance requirements is one thing. Existing leases and tenants. This is if you're doing 5 units or above, there's a whole separate due diligence list I have for examining the financials of 5 units and above multifamily commercial. And it's detrimental that you analyze them, you beat them to death, right? Because the property value is based on the income that it generates. And 1 to 4 unit, the property value is based on what similar properties are selling for. All right. So we buy multifamily commercial based on what we see in the financials sometimes. We don't do that for 1 to 4 units. All right. So if the property is currently rented, review existing leases to understand tenant obligations and rights. Evaluate the quality and reliability of current tenants and assess the potential for rental income. Now, when my students are running these 4 data points, right, they got a subject property. They're looking at, all right, what does it cost or what am I willing to pay? What does it cost to fix up? What's it going to be worth when I'm done? How much income can it generate? If there are tenants already in there, then data point number 4, how much income can it generate? Well, guess what? It's how much income is it generating? That's what you put in that number. All right. Because you may be obligated for a certain amount of time to those leases. And you may have to wait until those leases expire before you can do anything. Well, guess what? If you got a hard money loan and they are going to pay for the rehab, well, they're not going to wait for those leases to expire. So when they do that, what we call a construction holdback. So when you do a hard money loan and it's a mortgage product where they finance a percentage of the purchase and a percentage of the rehab, it's all done together. They do what we call a construction holdback. So when you start the rehab, you can go ahead and start the draw process, right? Now, this brother left his breakfast on the stove and went to drive Uber, not once, not twice, but 3 times. I had 2 people almost burn down my house. I hear you, Jason. I think you told us about that story. All right. All right. So let's, where do we go? Okay. So make sure you guys are reviewing existing leases and tenants. It's just very, very important. Neighborhood analysis. Analyze the neighborhood's characteristics, including crime rates, school quality, amenities, and overall desirability. I do not invest in the hood. I just don't. I don't invest in the hood. It's not profitable. There's too much risk. Um, there are too many things that can happen with just the general tendency, and it's just higher risk. If you are from the hood and that is your stomping ground and you're more comfortable in them areas, you know how to navigate, then by all means. But for me, it's just not worth it. I was overseeing 3,000 units. A portion of those units were in a bad part of what we call it's East Palo Alto, and it's not it wasn't horrible, but there was just a lot of issues that we had to deal with, and it was densely populated. I think it was made for this development was made for about 4, maybe 5,000 people, and we estimated about 12,000 people living there. So it was just an absolute mess. So if you want to invest in the hood, go ahead and do it. Just understand the risk. All right. All right. Now, anybody on Clubhouse, you guys have any of those? You guys got any questions? Let me know. Let me scan. Da, 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 da. What's up, Sam B? I see you there. If you have to wait 48 hours, then your decision making is not good. Okay. Yeah, you shouldn't. You should be able to make whatever decision you're making immediately based on the information at hand. All right. Dang, Jason, I'm surprised you gonna get carpal tunnel. Carpal tunnel, all that typing in there. All right. So neighborhood analysis, just know what you're getting, folks, right? You want to invest in the hood. It has its advantages from a cost perspective, but a disadvantage when it hits your financials long term. Just keep that in mind. Exit strategy. Now, folks, we're on step 5. So this is just, we're still in the due diligence phase. We're in that phase where you're, do I invest in opportunity zones? Yes, but keep in mind, just investing there doesn't automatically mean you reap the benefits. There's a process to take advantage of the opportunity zone. So, but yes, I do. But I don't lean on that. Like, that's not the reason that I invest there. If I invest in a particular place and it happens to be an opportunity zone, then great, right? But I don't go seeking out opportunity zones. All right. Exit strategy planning. Now, as I mentioned a second ago, this is the portion of the deal. We formed a group. We've had all the conversations. We've managed expectations. We've, chosen our legal structure. So we're ready to go. We put an offer in on the property. The offer got accepted. Now we're in the due diligence phase. In the inspection period or due diligence phase, we are looking at property inspection, title search. We're doing a financial analysis, market analysis. We're looking at zoning and land use regulations. We're doing an environmental assessment or having the report ordered, basically. We're looking at legal compliance, tax assessment, utility and service verification, insurance requirement. We're looking at existing leases and tenants, neighborhood analysis, exit strategy planning. So develop a clear exit strategy, including potential resale timelines and target buyer profiles. Hire an agent, let them do all that. All right. That's the easiest way to do it. Again, and if I'm saying that, I am a real estate broker, so I could list these properties myself. I still hire an agent. All right. Especially if that agent is well versed in that particular area. I invest all over the country, so I'm going to lean on the expertise of a local agent. All right. All right. Step 6. Acquisition and renovation. Now, this is all from the same guide. This guide is comprehensive enough to where I can just hand it to somebody and I don't have to teach them. Everything is outlined, right? Putting the group together, all of the conversations that need to be had with the group, everything that they need to consider through the due diligence period, through managing the project, all right? Now we're at step 6, acquisition, renovation, exit, right? Make an offer. So we submit offers on selected properties. We negotiate them. Then we close the deal. Right. We just went over all the due diligence as if we closed the deal and we were in the inspection period. Then we move on to planning and renovation. Your scope of work. Define the scope of work required for renovation. Folks, this is where people lose money. The scope of work. Now, when I'm teaching somebody how to do a scope of work, yes, there are tools and templates and things that I could just give them and they would be functional, right? They could probably get it done. But I want them to be able to do it without any of those tools. So, scope of work starts like this. We do it in 3 phases. 1, we make all the observations about the property we can. Doesn't matter if we know what we're doing. We can look at flooring and see if it needs to be replaced or addressed. We can look at paint and see if it needs to be replaced or addressed. We can look at the roof, and if we see patches and all these other things, we can note that that needs to be replaced, repaired, or addressed. Okay? It's not our job to be experts. It's our job to be able to hire and manage the experts. So we come up with an itemized list of everything that needs to be addressed. All right, we're going to need interior flooring. Go into the bathroom. Okay, we're going to replace this vanity, this mirror, these light fixtures. You probably want to take down the tile in the shower. Maybe we'll put a fiberglass enclosure in there, replace the toilet. And it's just a list of all these things. Now, step 2, you take that list and put it in a format that you can hand somebody. Okay. So you can put it on a template that maybe you had made. You can open up an Excel spreadsheet. You can have a space for the description of what needs to be addressed. And then you can have a column right next to it for the price. Okay. Obviously, that's going to be blank because you don't know how much those things cost. You're not a general contractor. Your job is to manage them. So you hand that document to a general contractor. And if they want to come look at the property before they complete it, great. But you hand that to a general contractor, and then the contractor gives you a price for every line item. Why not just have a general contractor come to the property and quote you a price? Because if you don't have it itemized on your scope of work, if you have to pivot in the middle, you don't know how much or where that pivot is going to impact your overall budget because it's so vague, right? If he just comes in and says, I can do this thing for 60,000, and then you change your mind halfway through about some of the things you want to do, you need to know how much that change is going to reduce your budget. And if it's not itemized, it's not going to be very accurate. All right. So, scope of work, budget, timeline. I coach people through that, right? You don't have to know what you're doing as far as that goes. Hiring contractors, get estimates, select your contractor, sign contracts outlining the scope of work, cost, and timelines. For my students, I teach how to do the contracts. They're very simple. I'll look at the contracts that they send me, and I'll if there's any language that I would add in there, I'll go ahead and just draft the language and send it back to them. Okay, all this stuff ties together. You guys that are in our real estate family, this is the hiring a contractor lesson you would look at. Now it's more comprehensive. Now it's called managing the rehab process. It's a little longer. So have that in your hand when you are working with contractors. And if you get stuck, just reach out to me. I'll navigate you through it, but it's pretty self-explanatory. All right. So you hire your contractors and you manage the renovation. Project management. So monitor the renovation process, manage the contractors, and address any issues that arise. This goes back to having that open line of communication with not just the group, but with the contractors that you're going to be working with. All right. It's okay to be wrong. Just don't be wrong long. And the more you're checking in, the easier it is to monitor the overall progress of the project. Okay. Now, when we are managing contractors, that is a lesson separate for itself because me investing from a distance, I have to have systems in place to motivate these guys to keep working every day. And I usually do that through my payment schedule. So I teach my students how to manage a payment schedule and make it work in their favor to keep the contractors working for the next check. So you're not paying them for work they haven't done yet. All right. So I'm glossing over it now in step 6, but just understand that there's more details that go along with that. All right. So project management, like I said, monitor the renovation progress, manage the contractors, address any issues that arise. Quality control. This goes back to what I just said. Ensure the work meets your quality standards and complies with local building codes. It's the contractor's responsibility, and I put that in the contract to make sure that they are monitoring local building codes, making sure that we're staying in compliance. All right. So here's a pro tip: divide and conquer. By clearly defining and dividing these responsibilities, your group can ensure a well-organized and efficient rehab process, leveraging each member's strengths and expertise to achieve a successful outcome. Folks, I've had many conversations, many talks with many groups. And I'll tell you right now, I've out of 20 groups, I would say maybe 2 of them are able to do this over and over long term. Those relationships, managing those relationships, and getting in groups with the wrong people, and it's I'm telling you, it's a mess. Learn how to do it on your own first. Okay, learn how to do it on your own. And 2 of those groups I trained, so those are probably the 2 that were that were able to go long term with this. All right. Now, a recap. We are discussing how to invest with friends. Okay. We are on step 6. So I'll do a recap of all of the previous steps real quick, and then we'll take a deeper dive into step 6. All right. So step 1 was define the group's goals and structure. So when we were talking about step 1, we were talking about all the, let's call it the meeting agenda for when you get this group together and you have your first meeting. You're going to identify your investment goals. And by the way, you guys that text the word yes to that number above my head, this is all in here. So I'm going to go over the highlights on this recap, but there's subtext in here that you guys will have available. Identify investment goals, define roles and responsibilities, risk tolerance and budget, develop investment criteria, legal and operational structure, strategic planning, establish performance metrics, have a communication plan, and contingency planning. Those are all of the things that that first discussion within the group should involve. Those are everything you should be talking about. Step two is forming a legal entity. I didn't tell you which one to form. I just told you all of the things to take into consideration when you're choosing which entity to form. And I also said talk to a qualified professional. Okay. Now, liability protection, tax implications, management and control, profit distribution, formation and maintenance costs, operational complexity, future needs, and scalability. Those are all of the topics that need to be discussed when you're trying to determine which entity to form for your real estate investing needs. Amen? Amen. All right. Step three was the financial planning. So, budgeting, cash flow management, return on investment, looking at credit scores and financing, interest rates, loan terms, tax planning, accounting, bookkeeping, financial reporting, risk assessment, exit strategy, financials, profit distribution. These are all of the things that should be discussed when you're talking about financial planning. And I would typically put one person in charge of the financial planning aspect of the group, somebody that has their stuff together. All right. Step four, market research. I would typically hire an agent to do this. My market research is a little bit more granular than the overall market, as I mentioned before. If I have an opportunity, I'm researching the property itself. The reason I don't look at an entire market is because there's good investments and bad investments in the same market. All right. Now, if I got to fill up 25 doors because I'm buying a 25 unit apartment building, then I'm looking at a wider. I'm not looking at just one neighborhood where I would have to fill one door. I'm looking at a wider scope of. I'm trying to gauge the demand, right? So I got 25 doors to fill. I got to make sure the demand is there. So my market research expands just a little bit. All right, that's step four. Step five was the due diligence. So after we did our research, put an offer in on the property. The offer got accepted. Now we're in the due diligence phase or the inspection period of the contract. And I have a checklist that is in the guide, and they are as follows: property inspection, title search and ownership verification, financial analysis, market analysis, zoning and land use regulations, environmental assessment, legal compliance, tax assessment, utility and service verification, insurance requirements, existing leases and tenants, neighborhood analysis, exit strategy planning. These are all check boxes. These are all the topics that you need to include in your due diligence, and I have subtext for every topic. So if you guys have this guide, it's all right there in front of you. Step six was the acquisition, renovation, and exit. All right. So we talked about making an offer, negotiating, closing the deal, planning the renovation. We talked about a scope of work and its importance and how to do it. All right. Our budget, our timeline. We talked about hiring the contractors, meaning get estimates, select the contractor, sign the contracts. There's some subtext there too, right? I teach you how to do all of those steps, and then manage the renovation. Project management, quality control, a system in place to make sure those things are moving along smoothly. I gave you a pro tip: divide and conquer. And we're going to get into divisional responsibilities for the rehab in a second. But the pro tip: divide and conquer. By clearly defining and dividing these responsibilities, the group can ensure a well-organized and efficient rehab process, leveraging each member's strengths and expertise to achieve a successful outcome. Now, if you want to hire cousin Mookie and and Muck and Leroy to go do it because you feel your friends and you feel that you can do that, I would caution you. Look how a person is handling their personal life before you decide to go into business with that person, because they are going to bring whatever it is that's in their personal life, whatever habits, whatever shortcomings over into your group. So if you have somebody with a 400 credit score and, is living check to check, don't put them in charge of the financials. All right. That's just a tip, folks. I've seen a lot of groups go bad. A lot of groups go bad. So, I'm saying this for a reason. So now, before I told you that this is not just for a simple flip. So this should be considered even when you have a big project. So it may sound like some of this is overkill, but it's better to have the information and not need it because your project doesn't require it than need the information and not have it when your project does require it. So when we talk about the division of responsibilities for the rehab, I have about 5 different positions that we need to consider. Really 4, because one of them is going to be the agent that we hire to list the property. Now, the first responsibility, that's the project manager. And what I'll do is I'll list the responsibilities and then I'll list the ideal skills for the person responsible for this portion of it. Okay. Project manager. So the responsibilities, they're supposed to oversee the entire rehab project, ensuring it stays on schedule and within budget. Coordinate with contractors, suppliers, inspectors, handle permits, and ensure compliance with local building codes and regulations. Communicate progress and issues to the group regularly. So basically what that means is they need to have an open line of communication and stay on top of these things with the appropriate parties, namely the contractor. So instead of the project manager reaching out to the building department, the contractor, they should be reaching out to the contractor to make sure that all of these things are being done and getting proof that these things are being done. Permit gets signed off, we need a copy of it. Amen. Amen. Next one. Oh, so the good skills for a project manager: strong organizational and leadership skills, experience in project management and construction. But folks, I will say, do what you can where you are with what you have. If you don't have these people, you may have to be these people, right? So number 2 is a finance manager. Those responsibilities include managing the rehab budget, tracking all expenses, and ensuring costs stay within the allocated budget. They handle payments to contractors and suppliers, prepare financial reports, and update the group on the financial status of the project. They also explore financing options if additional funds are needed. Now, I typically have this stuff in place already prior to even forming the group. But again, if I was going to hand it off, I would hand that off to the finance manager. Their skills, they should have strong financial management and accounting skills, attention to detail, and proficiency in financial software. Now, if you're just doing a single house flip out in, nowhere's land, probably don't need a finance manager. But if you're doing an apartment development, let's say you're doing 50 units and you got a rehab for 50 units, you better have all these positions in place. All right. Now, again, these are just things to consider when we are investing with a group. Okay. Procurement specialist, responsibilities. Oh, let me sip my coffee one time. Y'all ever get tired of hearing yourself talk? Put a 2 in the chat if you're tired of hearing. Don't do that. All right. Procurement specialist. Anytime you hear procurement, this is really somebody that is responsible for getting the materials. So their responsibilities: source the purchase materials needed for the rehab, ensuring quality and cost effectiveness. Yeah, this is all right. Let me finish this first. Negotiate with suppliers for better prices and terms, manage inventory and ensure timely delivery of materials to the site. Work closely with the project manager to align procurement with the project timeline. Now, we'll pause for a second. This is necessary if I'm buying my own materials, right? Sometimes I'm not buying my own materials. If the materials are included in the estimate from the contractor, then the contractor is responsible for making sure the materials, because we've already agreed to a price, making sure the materials reflect our expectations and stay within budget, right? Be prepared, though. You may have to pivot on materials. Materials are not etched in stone, right? My materials for a long-term hold, a property that I'm going to rent out, those materials are going to be a lower grade than materials that I would use for a flip if I was just going to sell the property. Why? Because the tenant for a long-term hold is more transient than somebody that is buying it for their forever home. All right. So those are decisions that have to be made. And if we have to pivot mid-project from keeping it to having to sell it, then again, that can impact our scope of work. All right. So procurement specialists, it's better to have them and not need them than need them and not have them. All right. But guess what? For the smaller projects, when you guys are just starting out, you're the procurement specialist. I like to pay for my own materials. I like to put them on, Amex or Chase Sapphire so I can get the points. All right. Quality control manager. Now, this is a position, and I think it's important for much larger projects. For smaller projects, just have a system in place to check quality control. The responsibilities: inspect the work site to ensure construction quality and adherence to plans and specifications. There's a way to do this. You can do this during FaceTime. All right. What's up, Angel? Angel, reach out to me. I need to check in on you, see where we at. I haven't heard from you for a while. Regularly inspect the site to ensure construction quality and adherence to plans and specifications. You can do this during FaceTime. Okay, you don't have to physically be there. My contractors, at one point, I had 4 projects going on at one time in different parts of the country, 5 including one that I had been lagging on up in Missouri. So I obviously can't be in all those places. Flights to all those, that would be too expensive. So we had a system in place. We would just do a FaceTime walkthrough, and it worked. 5, marketing and sales manager. Now, this is the one that probably doesn't need to be within the group, but because I would just hire an agent to do all the marketing and sales. That's what we pay them for. All right. All right, folks, we almost to the finish line. Thank you to the folks on TikTok that shared it earlier. Coordination and communication. Have regular meetings. Share the documentation. Have a conflict resolution. That's going to be in your operating agreement. There should be when you form your entity, there should be a conflict resolution section that explains how to resolve conflicts. But I'm telling you, folks, have your paperwork in order. Even if you have a good relationship with these folks, have your paperwork in order so it preserves the relationship. Okay. Now, step 7, marketing and selling the property, staging, marketing, open houses. That is all your agent. They should be doing all of that stuff, right? They are your marketing strategy coordinator. They are your advertising and promotion manager. They are your staging and presentation specialist. They are your open house and showings coordinator. They are your negotiations manager. All right. Step 8. This is the step that everybody loves: sale and profit distribution. The final stage in the real estate investment process involves sale and profit distribution. First, review and negotiate offers from potential buyers to secure the best possible price for the property. Common sense, right? But the highest offer is not always the best offer, folks. It may have too many contingencies, too many outs. Maybe they are leveraging too much. I can look at multiple offers at one time. I want the most solid offer, and again, it's not always the one that comes in the highest, especially if there is evidence in the offer itself that tells me that they may not be able to close. Okay. After the sale is finalized, settle any outstanding debts. Those should all be outlined prior to closing, so everybody's expectations are managed. Finally, distribute the remaining profits among the group members according to the previously agreed upon ownership percentages, ensuring fair and transparent financial outcomes for all involved. Okay. Final step: review and reflect. Look at what you learned during the process. What worked, what didn't work, and the things that didn't work, why didn't it work, right? And what will we do next time, right? There's going to be some times where you make money. There's going to be some times where you lose money. Welcome to the world of real estate investing, right? And no, you're not going to invest $5,000 somewhere and then walk away with $30,000. It doesn't work like that, okay? So review and reflect. Start with a post-mortem analysis by conducting a review meeting to evaluate the project's successes and challenges. This comprehensive analysis helps identify what worked well and what didn't. Next, discuss the lessons learned, focusing on how to improve the process and strategies for future projects. This reflection allows the group to adapt and enhance their approach, ensuring better efficiency and effectiveness in subsequent investments. You've got to get the learning process out of it. Again, you're going to have some wins, you're going to have some losses. Anytime I have a loss, there's one thing that I focus on in retrospect. Would I have made the same decision given the same information that I had available at the time today? If the answer is yes, I move on. I don't cry about it. Doesn't matter if I lost or won, I move on. Right? If the answer is no, then I gotta hold myself accountable. What did I miss? Right? Then I really have to get the learning out of it to make sure that it doesn't happen again. All right. Now, those were 9 steps. That lesson is called investing with friends, investing with a group. Now, you don't have to be a part of the group. Maybe you find the deal. Maybe you put it together. You meet a wholesaler. Wholesaler says, "Hey, I got this property." You run the 4 data points on it. Ask the 4 questions. What does it cost? What does it cost to fix up? What's it going to be worth when we're done? Then you put a group together, and maybe you don't come in with any money, but you still get some ownership because you're putting it together. And then go ahead and charge an acquisition fee, whatever you think is reasonable for your time. Maybe you can be the one that goes in and checks on the property, sweat equity, right? You can go in and check on the property. Maybe you manage all the communication. Maybe you take on this administrative role to ensure the group's success and get a fee for it. All right. You can be on the operating agreement with zero contribution and write yourself into the profit share. All right. So this is a way that investors can continue moving forward when they need to generate some cash flow. Start putting groups together, and knowing how to do that can be very, very profitable. Now, maybe you could do a $5,000 acquisition fee, but that's really, really low. But if it's a much larger project, you can make some significant money, and you get to determine how you write yourself into it. You can take an acquisition fee up front, and you can take part of the profits on the exit. It's up to you. All right? But being able to put these together is another revenue stream. Amen? Amen. Can it be done without ever seeing, let me see, can it be done without ever seeing the property? It can, but you got to be pretty savvy, right? If you're putting this together for a property you haven't seen, then you have to know how to invest from a distance without physically having to be there. So for example, you are going to look at what is a more effective way to review the property than me physically being there. Okay, well, property inspection. Keep in mind that has to be paid up front. All right. Well, how do I manage the contractors to make sure they keep showing up to work? Well, you do that through your contract and your payment schedule. You make all of the payouts event driven. An event driven payout means they have to execute X, Y, and Z in order to get that check. All right. So good questions over on Clubhouse. Let me go through and see if there's any other questions. I'm not tired, but you can get AI to make your voice sound like Beyonce's if you're tired. All right. Thank you for that information, Jason. I think we are all better for it now. All right. So I'm going to tap out, folks. I've got some stuff to do for you guys that text the word yes to 702-710-8030. I'll make sure I get this guide over to you. You guys that are in our real estate family already, you guys will find this in the portal under resources this weekend when I finish migrating all this stuff over. And let's go to the promised land. Folks, my name is Otis James. I'm a full-time real estate investor out of the San Francisco Bay Area. We're live streaming on Instagram, Facebook, YouTube, Clubhouse, and TikTok. I am a long-term hold investor. I'm also the founder of 4 Data Points Academy. We are the only real estate investing training platform that does not have an end date. So if you can find a training platform with more support, let me know. I'll pay for you to join that one. That being said, I think it's time for us to go ahead and wrap it up. I will keep it open for about 30 more seconds. Any entrepreneurs in the Clubhouse, put a one in the chat if there's any entrepreneurs here. If you're an entrepreneur, you guys are going to start seeing, well, I guess I can just talk to everybody. You guys are going to start seeing something called Venture U. Venture like joint venture, and then U like university, the letter U. If you go to ventureu.live, that is the entrepreneurial leg of the 4 Data Points Academy. And I've been wanting to venture off into the entrepreneurial stuff for years. I just needed, the right opportunity to be able to do it, and enough reliable people in my network to be able to fly in experts in every category needed to start or scale a business. And so we put together the International Business Retreat in Medellin, Colombia. It is the first week of October. So that is, just like I said, for somebody that either wants to start or scale up a business up to the $10 million mark. If you're already in business and you already have revenue of $10 million or more, we're not going to be able to help you. That would be a different retreat and requires a different level of support, right? But if you're looking to get from 0 to 10 million, then this is going to be for you. I have a 17-room villa waiting for everybody. I got a private chef and concierge, and we'll take you to and from the airport. And yes, there's more bathrooms than rooms. So I think we got 17 bathrooms. So that's one of the things I get concerned about, right? Well, how many bathrooms we going to have? Yes, it can be men and women. Yes, it can be couples. So it is a very It's going to be a very educational event. And we are making sure that you actually have the blueprint for your business by the time you leave. So you don't have to go hiring consultant, figuring out what to do next. As far as processes, anything from client retention, sales processes, automations, all of these things that are required to start or scale a business, we have the experts there, and they're actually going to coach you through it while we're there. They're not just going to say, hey, you need this, you need that. They're going to look at your actual business idea. I don't care if you don't have a business plan or anything. If it's an idea and you're there, we're going to show you how to bring it to life. All right. So, anybody interested in that, reach out to me. We only have 16 spots. We're not really marketing it yet. You guys may see it on my social media, but Venture U, that's what that is. Outside of that, we are going to have a separate 3-week program called Venture U that is going to do something similar for people that maybe can't make it to another country. But we're already planning the next one after this. This is in Medellin, Colombia. We will have one. We are going to have one in Thailand. We're going to have one in Dubai, and it's going to be kind of an ongoing thing. Any single, Jason said, any single Canadian Christian future first lady types registered in their 30s. Uh, no, Jason. There's no, we don't ask all those questions. We don't know. So, but good luck. You might want to go to Christian Singles Meet for that, brother. All right. You guys on TikTok, I'm going to go ahead and shut that down. I'll leave it open on Clubhouse. If you guys have any more questions, I'll leave it open for about 30 seconds. And if not,